Joining us right now on the markets is Julie Biel. She is portfolio manager and senior research analyst at Kayne Rudnick, also a CNBC contributor. And what are you thinking so far, Julie, about what you've seen from the banks?
It's been interesting, right? I think the banks, it's going to be a case of the haves and the have-nots. So your large money center banks that have taken in a ton of deposits, they're going to be just fine. I think the regionals were all very worried about what commercial real estate is under the covers. And it depends. It really varies by bank, right? I'm the most concerned about ones that have built up their CRE portfolio in the last 3 years when interest rates were at zero. I worry about that credit quality. So like an independent bank is a bit of a concern. They've grown their loan book. They've doubled it. And there are others. You just have to look at the mix of what is office, what is multifamily, which is probably a little safer. Those are the things I'm worried about right now.
M&T Bank up this morning after reporting its earnings. I know State Street was down pretty significantly. Are there specific things that you think will show up in these earnings numbers that you'd be paying the most attention to? Is it the CRE? Is it the deposit flows that we've seen one way or another? Or do you think this takes a little longer than looking at earnings for quarters that are already closed?
I think it's going to take a little bit more time, but I'm very, very much focused on how they talk about the credit quality that they have, what they've reserved against, and how that's going to impact the rest of their business. That's where I'm really the most fixated.
What else are you watching these days, Julie?
You know, we're still looking at how the consumer is doing and the health and strength of it. You know, if you think about, people talk a lot about the $2 trillion of savings that got built up in the pandemic. And the thing is we've spent $1 trillion of that. The problem is that the other $1 trillion of that, a lot of that is concentrated in the hands of wealthy people, and they're not going to spend it. So I think we overstate the health and strength of the balance sheet. We see that the average consumer is spending in excess of what they're taking in income. And so I think that's going to impact the consumer discretionary space as well. That's another concern that I have going into this quarter's earnings.
You know, you get the economic numbers. Like today, we got the Empire State Manufacturing, and that was way better than had been expected. So you get these hot numbers, some cool numbers here and there. It's pretty tough to make an actual argument that the economy is one way in some monolithic absolute terms.
Yeah, I think what we're seeing is that what's interesting about the pandemic is it kind of decoupled a lot of industries from each other. And so right now, if you think about semiconductor chips, they're in a recession. If you think about auto, they're probably going to be in a recession in the next year or so because they're finally getting the supply they need. So earnings should be okay. And I think that that has implications for the Fed and their ability to be able to gauge where the market is. If you're someone like me, you can make an argument for, you know, recession, fantastic economy. The data is there. It's just very conflicting.
And as far as the Fed goes, the conflicting data probably means that they're not going to stop raising rates anytime soon.
Yeah, I think that the challenge that they have is that they're looking at labor market data and shelter as the driving force. And I think they're very concerned about the 1970s. But something to think about is that in the 1970s, you had a lot more unions. And so when you had hot inflation, that CPI hardened immediately into wages. And that's not the case right now, right? Wages are much more flexible. And so most employers are going to be able to move a little bit more quickly than they had in the past. I'm a little bit worried that they may be overcooking it in order to beat inflation, but there's the ability to flex down if we need to.
Although somebody this morning was talking about the Atlanta Fed's labor measurement system that did show some pretty hot numbers in wages overall.
Yeah, I think that it's right now, the wages are quite hot. The question is that if demand softens materially, what does that mean for the ability for wages to stay as high as they are? And I think you're going to have a mix shift that's pretty important to understand, right? Your kind of white collar work person probably has a more at-risk job than your frontline worker. So it could make wages look softer and deflation stronger if we see those people in the middle income losing their jobs and frontline hourly workers keeping them.